I think there, are a couple of key things that a lot of our panelists saw. One was looking at the expansion of the availability of alternative investments. Rick talked about it as the democratization of alternatives, and that's by using mutual funds, a product that many investors and advisors are already familiar with, as a way to access alternative investments. One of the other things we saw is the way that alternatives can help manage risk and volatility in an overall portfolio.
We use a very refined definition of what an alternative is when we run our Lasso long and short strategic opportunities portfolio of alternative mutual funds. And we have a very specific definition. First, we look at the nature of alternative strategies, and we ask, is one of these funds using short selling or hedging? Number one, is that an alternative strategy they're trying to implement? Number two, are they using a alternative instrument such as futures or derivatives? Or number three, are they using another alternative technique such as illiquid securities or leverage, both of which are strictly limited in the mutual fund world? But those are the 6 basic criteria we hunt for in determining if something is implementing an alternative strategy.
Well, most investment firms are recommending anywhere from 10 to 30% of a total portfolio to different types of alternatives. We feel a direction that to have a meaningful impact on the portfolio, one should have at least 10% of their total assets within the different alternative strategies. I think the best way is to blend them into a stock and bond portfolio. Because of the fact of the low correlation, it tends to dampen the overall volatility relative to a stock and bond portfolio by itself. It's over the long haul that they provide some return stream that'll be additive to a stock and bond portfolio.
Investors in alternatives are looking for a couple of things. One is they're looking for volatility reducers in their portfolio, something that's going to allow them to have a more consistent experience from a volatility standpoint. So that's one option. And then I think the other thing investors are looking for, and this is something they haven't been finding lately in the alternative space, is they're looking for increased return. They want to have opportunities to make more money than they've been able to make in the equity markets or the traditional fixed income markets. We've been through a number of phases in the alternative space. I think if you go back to the early to mid 90s, you had a period of time where alternative investments were relatively new. There weren't a whole lot of managers or dollars chasing some of these opportunity sets, and so logically the returns were a lot higher and a lot more attractive in those days. I think today the focus has shifted more towards using alternatives in that volatility reduction role. But I think for alternatives to really grow going forward, they're going to have to balance those two objectives of delivering strategies that reduce portfolio volatility, but also delivering enough return to make investors some money.